Thank you very much, Ryan. It is a pleasure to have you all here today for the first Big Effing Deal. Today I have some amazing VCs to kind of impart some amazing knowledge and experience on all of you. We're really focusing this event all about helping all of you raise your next round, especially if you're an early stage founder. And so today we have 3 investors who do a lot of early stage investment. So let's just get started by doing some quick intros. Make sure to mention the geos you invest in, check sizes, how many deals you do, and if you have any specific industry focuses. Why don't we start the end with Cyril?
Hey everyone, my name is Cyril. I'm a general partner at SOSV, and we invest at very early stages, essentially accelerator level. We have 4 accelerators worldwide, Hacks, which is specialized in hardware, IndieBio, which is specialized in life sciences, China Accelerator in China for software, in Foodex in New York. We have $250 million funds, and we've invested in over 600 companies to date, which makes us pretty active. While we don't lead Series A, we have quite some experience in participating into them.
Hi there, my name is Stephen Forte. I'm the managing partner at Fresco Capital, and we invest in 3 sectors. One would be EdTech, another one would be digital health, and the other one doesn't have a good name, so they're called the disintermediation of rent-seeking middlemen tech. You can come up with an acronym, and we could do that. And those are the 3 sectors we like. Geography is worldwide, and the company has to be global. So I'm not looking for the Uber for Venezuela. I'm looking for a Venezuelan company that wants to be global, like Uber, that wants to be global all around the world. And our check size is usually, the company, the stage that we invest in is usually a late seed, pre-Series A round. So typically seed extensions we'll get into, or big seed rounds, like a $2 million raise. And our check size is probably around the 250K range. We follow on for Series A, but virtually never have led the Series A. A handful of times we have interesting, kind of strange deals. And then in my spare time, I run an accelerator for the Vatican, which will be out in Rome this summer. So we do there is 100K checks in more seed stage. So almost the same kind of thing. So a lot of companies looking for Series A's.
All right, Raymond Liao, one of the managing director at Samsung Next Ventures. Samsung Next is also called the Global Innovation Center of Samsung Electronics. So we focus on seed, Series A, and Series B. Sort of invest globally. Focus on software and services. So everything that touch Samsung Electronics, like mobile, smart TV, home appliances, IoT, you name it. Right. So average check size, seed is about $500,000, 1 million in Series A, and 2 million in Series B. That's average.
Cool, thanks everyone. So if I can simplify what you just heard, accelerator VC, kind of traditional late seed and A VC, micro VC, and corporate VC, okay? If I can just put you all in a box. Make it, yeah, I guess I should have. Yeah. Okay, so actually first I want to survey the audience. Who are currently founders of a startup? Raise your hand. Okay, so that's about 50%, 60% probably. How many of the founders in the audience have raised capital? Raised capital from anyone for this startup that you are working for? Okay, so about half of the crew that raised their hand otherwise. Okay, cool, that helps. So we're gonna get started. We have VCs on the panel, so I have to throw them a softball, something to kind of build up their egos first. So we're gonna start with an easy question. We'll get to the harder questions later, but the ego building question is, I want everyone to tell me about what you feel like is the best deal, especially since we're talking about Series A. Let's talk about your best Series A deal that you've been a part of, and tell us a little bit about how it came about. Who wants to jump in?
Damn. All right. I guess it's gonna be a fairly easy one. About 5 years ago, when we started Hacks back in China, we had a company called MakeBlock, which does STEM education kits, robotic systems, essentially. It was just a one-man show back then. And it was a pretty interesting experience because since we deal with hardware, we deal also a lot with crowdfunding. Those were the early stages of crowdfunding. We did a Kickstarter campaign. That company just did $180,000, which back then was pretty good, but nothing too crazy, and nothing obviously too crazy nowadays. That company was very scrappy, and we didn't hear about them for about a couple of years, until they were like, well, actually, we moved up to, I think it was maybe 4 to 5 million in sales in the first couple of years, type of thing. We just received a term sheet from Sequoia, because essentially, they managed their costs well, they were all profitable and whatnot. They invested $5 million at a $50 million valuation, and that was probably the easiest one I had. MakeBlock now is about 300 people 5 years later. They've just raised a pre-IPO around $40 million. Always been profitable, never actually touched that Series A money, which is something I would encourage you guys to do.
And back on the original question, how many deals do you do a year? Across all?
Across all, 300.
So 300. When you do 300 deals a year, you're going to have wonderful situations like that where 2 years later you haven't heard from a startup and they contact you and say, hey, we're raising from Sequoia today. Right?
Absolutely.
That's probably not a story you're going to hear from Steve here.
Well, right, because at the accelerator level you have far more surface area, where at a traditional VC fund, you probably invest in more like 15 a year, which is probably about our speed. And that includes follow-up, previous, right, so we're following up with previous companies. But probably our easiest Series A story was one of our companies where they started out as a Kickstarter project, and they were looking, like most Kickstarter projects, they were looking for some investment to kind of get to production, which they did. And then they did a seed round, which we participated in, and I forget the terms, but it was something totally normal, like, we put $100K in on a note that was, single-digit $1 million, cap. And, probably about 6 months later, they called us up and said that Bessemer Partners is leading their Series A, and they want to take the entire Series A. So they want to crowd out all those other investors, because when you invest with a convertible note, you do not actually have the pro rata rights. And for those of you that don't know what pro rata rights are, that's my, as an investor, right to continue to hold my percentage of ownership. And so if I, great example of that is if I put money into your company, I own 3% of your company, when you do larger and larger rounds, pro rata rights gives me the right to put money in to keep that 3%. And Bessemer just said, no, we're taking the entire round. And I was getting ready to put my dukes up and fight Bessemer. I'm like, okay, I can take these guys on. I don't care, little Steve versus multi-billion-dollar fund. And the founder said, no, I told them to go after themselves if they don't let you guys in, because you believed in us in the first time. And that was a few years ago. And that founder, we stood by him, he stood by us, and like MakeBlock, they just closed a $100 million round, which again, the Wall Street people and the private equity people told us we couldn't participate. And he goes, as much as you guys want, right? And the name is Spire Global, and they make nano satellites. So they've been in a very sexy space as well. And making money on a nice path, but it's about the relationship with the founder. I was telling somebody here, it's about the dollars you take as a commodity. So because we built the relationship with the founder, we participated in every round they've done, from the 500K round they were raising to the $100 million round that they were raising.
So that's your first tidbit of advice, everyone, right? Is don't screw your early investors, right? At A, because this is a very typical story, right? You take a lot of notes from people who believe in you early, and then you get a lot of traction, and then Sequoia wants to take the whole deal. But yes, please protect the early investor guys. Okay, so Raymond?
All right, so I'm a corporate VC, right? So the success to me is different from financial VCs. So the story I can tell is that we found a company from Kickstarter. That's about 4 years ago. And this company is based in Boston. So we led the Series A, and we brought in GE, Synchrony, and Visa. Then within about half a year, we acquired the company. My project team acquired the company. And then within additional 3 months, the company's product is in tens of million smartphones. That's Samsung Pay today. Okay, so that to me is a great return to the not necessarily to the investor, but to the entrepreneurs, because they get a financial exit, but more importantly, their technology show up literally on hundreds of million devices today.
Okay, so of all the startups, many in this room who have raised a seed stage, I think we have probably 30 hands raised that they've raised this. Let's assume they've raised the seed round. 70% of those 30%, and 70% of all seed, all startups that raise a seed do not raise an A. They fail to raise an A. Okay, so there's an incredible gauntlet or a bottleneck between seed and A. What are your theories why? Some say Series A crunch, or some say too many startups, some say too much money in early stage. Lots of reasons. What do you guys think?
It's actually a combination of a lot of those things. A seed round is specifically about building your business model and getting a product market fit. So a lot of companies will go raise that seed round and then continue building the product, but not necessarily figure out the business model or find that proverbial product market fit. So then when they're trying to raise a Series A, an A is about all the metrics, right? So a seed is about telling you a story, tell the investor a vision, tell me a story. An A is show me, right? Show me the data, show me where you're going. So a lot of companies fail to get that critical mass, fail to get those customers, fail to get that business model, and then they're not able to go raise the A. So there's a little bit of a combination of, maybe there's a little bit too much seed money out there, but that's really what it is that 70% that does not go on to raise an A. The problem was that they never had that ability to get the product market fit.
Yeah, I think it's compatible with, essentially because there were more startups at the origin, it pushed kind of the post to later stages. And we often say that the Series A is the new Series B, which means that the bar just kept on climbing over the last 5 or 6 years. A Series A 5 years ago was something where you have some kind of traction and you're starting to grow, but it doesn't need to be full proof points out there. Barely revenue, great, and maybe you raise $5 million, and that was a proper Series A. But nowadays, when we talk about Series A, it's a $10 million round, and that means that it's kind of the new Series B, which creates, needs more, way more traction. So the semantics are actually not very interesting, although somewhat they are, because VCs have really that particularity to fund certain stages. But you can definitely see the fragmentation, and I'm sure you have all experienced it if you started to raise money. Between the pre-seed, the seed, the post-seed, then the bridge to the post-seed, the post-seed, and the pre-A to the A, and it's pretty crazy. But and it sounds like most of you must be like, what the hell is going on? But it's literally across everybody, and yeah, the bar kept raising because a typical VC will do 10 deals a year or something. And they will have plenty of choices these days, so there are lots of really good companies. So you are in competition, not with your direct competitors in your market, but with everybody else that is actually raising a Series A as well.
I kind of just build on this question, and I think you both alluded to it a little bit, but how do startups know when it's the right time to go for their A, as opposed to a seed extension, or do another bridge, do another 500K in notes? How do you know it's the right moment to go out for the A?
Well, the first thing is basically you can test the market. Do you get attention from the A round investors, right? The other thing is the other side of the parameters you have to consider is you don't want your valuation to be too high, because then you basically set up a death trap for your B round. Because if you cannot fulfill that, the expectation, right? So I would say most of the companies really you see, okay, can I get traction from the A round investors? You cannot, then continue to raise the smaller amount so that scale down your growth path.
I'll say it's really a process, and it's actually really dragging over time. Raising a Series A is it's not something that you do in a month or two. It's literally at least 6 months of effort. Generally, or sometimes it sounds like it's almost a year of effort, where you've engaged with the investors early on, and you are kind of trying to get the metrics that they're looking for. And it's a very difficult and frustrating exercise, I think, for everybody. I mean, entrepreneurs and early stage investors is actually to figure out what those metrics are. And the post keeps on moving, and it's never good enough. And of course, there are other deals coming in the way. But it's necessary to really get a hook and expect a long period, at least 6 months to actually close the thing. Once the hook is there, the VC is ready to invest almost, but there will still be a lot to clean up, a lot of due diligence required. Again, Series A, new Series B means a lot more due diligence that you are used to, and that takes a lot of time. And the latest is I've been at Series A took about 5-6 months to close. So it's a long time, which means that this is why you end up with those $1 million bridges that keep on bridging the company to the A. I think we haven't seen entirely the end of this game, and whether or not the Series A investors will bite, but get ready for a fairly long process here.
I make the argument that if your process is taking long, you're probably too early, and you should probably go back. And as Cyril said, consider those bridge rounds or those seed extension plus pre-A rounds, whatever you call them these days. Because raising a Series A is actually really, really easy once you're ready, because you have to do two things. You do these two things, the VCs on Sand Hill Road will start, you just drive down Sand Hill Road and they'll start throwing money out of the windows at you. You build a repeatable business that scales, right? Two very simple things, but of course very hard to do in your startup, right? The repeatable business part is pretty easy, right? You see about the business model that's repeatable. And then the scalability also, of course, means as you go from, if you have inventory, go from 100 items in inventory to 200 items, you don't grow by 100%, you grow by 300%, right? You have to have an exponential growth rate, not a linear growth rate, right? So you can start doing those two things. You'll raise a Series A quite fast. But as Cyril said, it takes a really, really long time to raise the A because you're probably in the process of doing those things. Because once you've built the scalable business that's repeatable, raising the A is fast. Wow, that was cut off. I think I ran out of time. Cut out. It was the time for an A.
Hold up.
We can talk loud.
Yeah, you're protecting it.
He's very loud, it's okay.
My name means loud in several languages, Forte. I think in French.
Wow, I think both the mics just went out. All right.
You can hear you okay.
Okay, well, let's do this without mics. All right, so Cyril just mentioned that there's some metrics to attain. Steve also mentioned that you can walk down Sand Hill Road and people throw money at you if you have a repeatable, scalable business.
It's hard to do.
Right? And so what I'd really like us to impart to the audience today is, what are some objective metrics that a startup could to really goal for and say, okay, once I'm here, then I know that it's worthy to start pursuing my A. What are the metrics that really justify the A? So basically I'm asking you, what are the metrics you look for in Series A investments? Feel free, I know that's a very broad question and you all invest in certain verticals, so feel free to tailor that specific to the verticals that you invest in. Hit on anything from run rate, revenue, GMV, CAC, DAU, MAU, LTV, everything else. But when you do, please mention what that means so that everyone...
I don't understand half of that.
I don't actually. I just Googled metrics a few minutes ago. I said, CAC, what's CAC? No. So yeah, let's try to get as specific as possible. Steve, I'm looking at you.
Looking at me. Okay. Wow, look at that. I can amplify.
Thanks.
So I'll make the argument that there's no one number. So a quick example is a founder in my portfolio sat down next to me and goes, we're almost at $1 million in annual revenue, which is the magic number I need to automatically qualify for a Series A. And I laughed so hard like the water came out of my nose. So the argument is, of course it depends on sector, it depends on thing. So that's a company they're now $2 million, that company. Still haven't raised a Series A, by the way. They've raised lots of seed extensions. And that's because their revenue is very lumpy and it's mixed between non-scalable and scalable revenue, favoring more of the non-scalable revenue, right? Which is a lot of, for lack of a better term, consulting. Right? There's a lot of just stuff they're doing for their customers that they're then charging money for that doesn't scale because it takes a human to produce a report or something. And the kind of SaaS side of their business is churning away but not growing exponentially. We've had companies in our portfolio that had maybe like, $500,000 in revenue and raised a Series A in like 4 weeks, right? And that's because of the growth rate that they had and the metrics that they had. So if you're looking specifically at metrics, again, it goes back to that repeatable business that scales. So what does that look like? If you are a SaaS business, we look at a lot of SaaS businesses, and Barrett mentioned CAC, right? Customer acquisition costs. So if you have a customer lifetime value and you have a customer acquisition cost, that's to me what a business model is, right? You figured out where your customers are and how much it costs to go get to them. If you're like at around a 3x ratio, right? So every dollar you spend, 3x comes out with a payback period in like 6 to 9 months. Like that's what the successful, SaaS businesses do. So that would be a successful metric to look for. But it's not the only metric, but for every type of business you want to look at the comparables. So I just chose one off the top of my head because he said CAC and we're making fun of it. But successful businesses, that was Salesforce's ratio, right, when they raised the Series A, right? So you look at a comparable and see what they've done, as long as you, again, got that repeatable business model, right, that scale.
What if my startup's CAC is better than Uber's? Should I raise an A? That was a joke, everybody. You can laugh now.
But actually, it's a good point though. If your CAC is better than Uber, and you are in a completely different industry.
It's very easy, right?
Right.
What is it, about
If you're in a different industry, it doesn't matter.
I agree. So this is really industry specific. So you would pay attention to your comparables. And most of you probably don't know who are your comparables, what are the financials of them. So that's your challenge, right? And also you say, I only have a few months of revenue if I'm lucky. So what do I show? Right? So there I would suggest you really nail down the very few paying customers you have. Okay? Because all we have to see is what are early evidences. That's confirmed evidences. Okay, this is the customer acquisition cost. Because I test this, maybe I'm early, I only have 10 customers. Okay, this is how I validate it. And understand what's their pain point, why they're willing to pay how much to me. Okay, so you can sort of, when you are small, you basically have to understand the use case. If you don't have a large number of statistics to show yet. Yeah, that's sort of you are in the chicken and egg phase that you should get stuck. Okay. So it's more bottom-up approach here. It's probably what we are looking for. And also the other hint is that when you don't have a large number of revenue to show, you show velocity, okay, the growth, the speed, right? Or you don't have revenue, you show number of users, okay? And then show early signs you can monetize. Why so? That's where comparable to help. Okay, so this company maybe in US, you are based in China, there's a company in US, they did this thing. They turn on monetization, then within half a year, they have this much revenue. So you basically have to show this kind of evidence to educate the VCs. Sometimes VCs, they do not know the problem you are solving, usually. Yeah.
All right, I was thinking a bit about hardware, and it's both fun and sad at the same time, because we're talking generally about businesses that actually have revenue, in theory, you could actually raise a Series A without revenue, and some entrepreneurs manage to do that, but generally they have some kind of pedigree, or they will be more or less in the software space because they have growth to show. But in the hardware space, it's really difficult to do without revenue, which is both a blessing and a curse, because you will start with entry revenue that could lead to your seed round, and then you are going to continue to develop the business up until a certain metric, and at that point, we're still talking about revenue, but we're also nowadays talking about the recurring revenue that is sitting on top of the hardware, or the community that is surrounding that business through the app, etc. We'll be talking about, in the case of Dropcam, for example, the recurring revenue were pretty nuts, which is why they got acquired for $500 million by Google eventually. If you don't have this kind of metrics attached to the piece of hardware you're selling, whether it's B2B or B2C, it will be very difficult because you end up with somewhat non-recurring revenue, and you will get to retail if you're B2C or to large customers eventually, but the bar will keep on growing. So from things I've seen, we discussed about a company that reached $4 to $5 million, but that was three years ago, essentially raising a Series A at a fairly healthy valuation, and dangerous one to the point earlier. Is like if your valuation is really high, then the expectations will be really high. If you're in the consumer hardware space nowadays, it's really difficult to raise a Series A even with $10 million in revenue. And at this point, it's pretty interesting because you are, depending on where you are on the planet, you are considering becoming a profitable company in theory, if you respect, the margins that you need to have in such a business. And yet, it's still difficult for VCs to fund these kind of businesses, in particular because they generally don't want to fund the inventory aspects of it on the way up, which is what banks are supposed to do. 10 million in sales versus 50 is still a big risk to be taken by the VCs here. So the bar is extremely high. On the other hand, sometimes VCs will also take advantage of B2B hardware, like in robotics in particular, because those machines are fairly expensive and it takes time to get to market. And yet, even the company has raised a very little amount of money, sometimes the valuations are too low. So the timing of raising your Series A here is important, because if your valuation is too low, you are literally, after Series A, you may have, you'll probably be below 50% ownership. It's quite possible you will be below 40% ownership, and yet you will have raised only like, $10, $15 million, which, is not so cool. So we can probably talk maybe later about the bad scenarios for you not to get into.
I can answer that.
Go for it.
If you remember, I said it depends, and both of us talked about the comparables. The other thing that you can do that's metric based is have your business model figured out with some validating revenue behind it, which doesn't necessarily mean having hundreds and hundreds of customers or millions and millions of dollars. I'll give you a quick example of one of the companies in our portfolio. About 3 months ago, at the board meeting, she said, this is one of the ed tech companies. She goes, well, we know how much the average contract value is with the university. Okay, that's the beginning of knowing something interesting. She's done enough deals with these universities to understand. Then she goes, we know a salesperson can close this many universities per month. I'm like, wow, this is good metrics. And then she says, we also know how much we pay the salespeople, obviously what the commissions are, all that information. And we've now figured out how long it takes the cycle one through. Right, so meaning is we know that the funnel of sales is 9 months or 8, whatever that number is, and we know how to go put them into the funnel. She goes, is that enough metrics to raise a Series A? And I like dropped my jaw, and I'm like, yeah, you should go out and raise a Series A tomorrow. Right? That was 3 months ago. She has closed that Series A, by the way, in 3 months, because she had all those metrics and had enough data that goes into those metrics. Similar to when we were talking about the CAC and the LTV and things like that. Even though her revenue wasn't through the roof, millions of dollars, she had enough revenue as a business long enough where you can extrapolate that data out. So sometimes it's just saying, well, here's the business model. Right? Salespeople close this many deals, this average contract size, here's what the funnel looks like, here's what we pay people. As opposed to like businesses I've ran in the past, where like the VCs would ask me questions like, oh, so you're gonna expand into Asia, how many salespeople are you gonna need? I'm like, 20? Like, where'd you get that number from? Sounded good, right? They know exactly how many salespeople to add in every region, how much it's gonna make them, things like that.
So I think the quantitative answer, the qualitative answer to the quantitative question is it depends. But basically, but again, you have heard over and over the same sort of idea. Concept is that at seed, it's all about finding that product market fit with a very specific addressable market, going out to investors in A and saying, we have proven this here, by raising an A from you, we can scale this to all these other markets that we've been ignoring so far. Okay, and so it doesn't necessarily take huge numbers to prove that, as long as you can prove it in this relatively small scale.
Yeah, I'd like to add on that actually. It's very important that if you think you're going for a Series A, you are selling $1 billion company. I'm not understating that, because the VCs are very different beasts than the early stage investors, who generally, might side with the founders and also have vested interest for the company to be sold at $30 million or 40 or whatever, because they own 10% of the company and they'll be happy with their IRR and whatnot. But at the moment you step into the real Series A room and you take that money, you are swimming for the fences, and any other option is over. So keep that in mind depending on what kind of businesses you want to build, and sometimes how long you've been for it, because it may take you 5 or 6 years to get to a Series A. And I've been there with some founders, and the conversation went a bit like this, like, well, we just received acquisition offers for X, and the VCs essentially, we didn't take it, and the VC is matching that valuation for a Series A, except that the terms attached to it are essentially, participating preferred, or they will have a veto on the sale. And the company is 5 years old, and they wish they could, they're happy at selling it for $15 million, and nobody would be happy with that, except the VC that just came in with, $5 million or $10 million, and the valuation is still not so high. But the message is quite clear: is there won't be any sale under $100 million, and probably under 10 times what they paid for it. If it was $30 million, a VC is not going to sell. It's going to put a veto for $300 million, even though if it sounds better for the founders and early stage investors, just don't care. So make sure that you manage those expectations and be prepared to go all the way if you plan to raise a Series A.
It's a great addition, is to really study the interests of seed investors versus institutional A investors. So drastically different, completely different animals, and if you go in with a similar pitch as your seed, you're going to get kicked out of the boardroom. So great addition, Cyril. Okay, so let's talk about the qualitative a little bit. How do you weigh, at Series A, how do you weigh vision and story versus true metrics? Vision and story, where I'm going to take this company. The $1 billion story that Cyril's talking, how do you weigh that versus what the actual metrics, revenue, and so on that they might be having at the moment? So how do you weigh that at Series A?
I would say vision is very important, but you need to have a substance to back it up. So to me, as a corporate investor, I would look into technology innovation, or unique market insights, or your business model innovation. Yeah, you have to be able to explain that, right? The other thing I would say is the team. Okay, beef up your vision with the team. So why you can do it, why your team can do it. So to me, I get more inspired. I would say my preference is more on the bigger vision, because that gets me more excited than the metrics. Because I know the company I have seen so far, in the C stage to A, none of them have great metrics. Sorry, none of them. Okay, because no number is big enough for me. Right? That's very realistic. No numbers are big enough.
So I've always said, I think I mentioned it even just in one of the previous questions, right? Your seed round is telling the story and selling a vision, because at best you have a product and you might have a customer or two. That Series A, you have to have some data, which is the path of executing that vision, right? So you definitely favor the tell me, or the show me, right, side of the tell me story. Like tell me your vision or show me your data. In Series A, you're definitely favoring that that data, but it has to be against, as Cyril said, some larger vision. I don't necessarily agree with him that you have to go and pitch everyone as being a $1 billion company, but it has to be a really big company. And I guess nowadays the $1 billion company is the what's in vogue. But it does have to be something that, when you start doing the math, has to be quantitatively anywhere between 25 and 100 times larger than what you're doing in your Series A, right? Like, so if you have like $1 million to $2 million in revenue, right, you have to be looking at a company that's going to be $100, $200, $300 million in revenue, right? Long term, right? And demonstrate the path to getting there, right? And that's actually what it is. So it is a vision, right? You know, we have this vision for this big, bold, billion-dollar company, but the path of getting here is laid, the groundwork is laid now, and here's the metrics that do it.
Okay, my next question is, you guys have alluded to a few kind of red flags that come up sometimes in deals that make you just want to pass on the deal immediately, just in passing already. So I want to bring some of those out. What are some red flags, basically, that if you hear in a pitch, in a deal, in a meeting, in a deck, about the company, something they say, where they're going, that makes you just say, I'm going to pass on this deal right away?
So I'll take the standpoint of a Series A and kind of the things that I've noticed happening. We touched over there about the team, and it's undoubtedly a key element of the Series A. So much so that essentially you should prepare again the year before your management team and everything surrounding the company. At that stage, essentially there is no stone that is left unturned by the VCs looking through your company, and they will generally notice holes, as missing a CEO or missing a VP of sales and whatnot. And generally, as a seed company, you will make excuses for it because you cannot pay those people and you don't have that management ready, etc. But you actually have to make that effort and make sure that your team is absolutely complete and stellar, so that there is no question asked. And for those that are where you are missing, people, essentially you have already a list that is up and ready to go as soon as you get a series of financing. It shows a lot of the maturity of you as a manager at the first place of the company. And I think it extends further into how you treat your board and your board of advisors and your board of directors. And here it's a bit more diving into the history of the company and essentially showing that you've been holding actual board meetings, which you absolutely might not have done yet, but showing that you have that maturity and that you've had that habit and that you have board materials that you can share over 12 months to any prospects, Series A investors, generally fairly impressive. And just the fact that you get your shit together as running the company is important. There are other elements that we can talk a bit later about the board, in particular having the seed investors and whatnot on board.
I'll add one of the red flags is the communication of the founders, where if you ask as an investor, you're in a presentation, something obvious was skipped over or glossed over, and you ask some simple probing questions, and there's a lot of secrecy. And I'm not even talking about like, we're not going to disclose our core proprietary technology, our algorithm to you. I get that. But the unwillingness to talk about it at all is a bit of a flag. And it's not a flag that you're too secretive, it's a flag about your communication style back to investors. So having a disengaged investor, it's okay if you have seed investors that are not doubling down on your A, but if you have disengaged investors that want nothing to do with you, or founders that have nothing to do with you, it just tells me that your communication style, there's something off, and you may burn bridges, or you may not have good relationships, or your relationships end poorly. Because the investment in your company with a Series A investor is a long-term commitment, right? It is a 5 to 10 year journey together. So if it starts off with a lot of like secretive or really, really long time to respond to emails, or the reverse, like 10 emails in 10 minutes. So it's really the communication is one of the flags.
Yeah, I agree. Let me simplify that. It's basically you have to be true yourself, be honest. Because when you reach Series A, the investors are institutional investors. They can easily spot the flaws in your story. They will do reference check. Good investors talk to each other. Okay, so you should not hide things. You will have certain challenges. Just be upfront, explain, and then explain how you overcome it. Okay, you had a setback in the past. You lost a customer, but then you explain how you overcome it. Okay, that's one thing. The other thing is major red flag for me is if you do not understand the problem space. What's the problem you are solving? What's the customer pain point? If you cannot explain that very clearly, then that's a big turn off.
Okay. So let's talk a little bit. We've got a few more minutes before we're going to go to questions from the audience, so get your questions ready, everybody. But let's talk a little bit about terms. What terms do you feel like founders should be most concerned with? And what terms of the deal, that you think founders should not really stress over? And then what terms do you see that founders often misunderstand and that might cause you frustration? So, who wants to go on? Cheryl, you've got the microphone.
All right, so you should not care about valuation. Of course you should care about it, but not as much as you think, because it's very difficult to, we mentioned that before, but to just manage the expectations. If someone puts $1 million at a $20 million valuation, they're going to expect that in 1 year you won't have blown up the entire pot of money, and then instead your company is going to be worth $30 million instead of 20, probably more obviously. If you don't, essentially you are absolutely, depending on the investor base that you have, you are looking for a down round. I don't know if anybody has seen Teespring today news. Teespring, you're familiar with that? They are selling t-shirts. They raised, was it $200–300 million? No, there was a valuation of $600 million or something. They raised hundreds of millions or whatever. But anyway, today they've been recapped at $5 million investment on $11 million valuation, and it's been running for 5 years, and that hurts quite a bit because everybody got washed out. Founders equity, ESOP, everything, etc. So the down round is ready, and this one is a bit crazy, but essentially you are better off ending up with something that goes on the way up, slowly but surely, and that is just good management of the expectation. I have some other stuff, but obviously not.
I think for terms, Brad Feld said it best in a book called Be Smarter Than Your Venture Deals, Be Smarter Than Your Lawyer, which basically walks you through the entire Series A term sheet and tells you what to focus on and what not to focus on. And he makes a key point that I have then ripped off from him and said, your lawyer is a reflection of you. Right? So if your lawyer is coming back and arguing over the clause that says, as a founder, this is like your only job, right? Or things like that, that's in every single Series A note of all time, right? You have bad lawyer and things like that. So I would highly recommend that book for the things to kind of look for. But more importantly, something you said is one of the things that founders miss, and it's actually not something that they miss, but they misinterpret, which is a liquidation preference. And liquidation preference is exactly what it sounds like, at liquidation, and liquidation usually means there is a sale of the company, or it could be the negative type, where there is a bankruptcy, or an IPO. Technically it's not a liquidity event, but it becomes a liquidity event for all effective purposes. And a liquidation preference says, if I put $20 million in and have a 2x liquidation preference, the first $40 million goes to me, right? And then the rest is split evenly. And then there's ways with participating, non-participating, but founders understand that because they usually ask their lawyer to explain it to them. And then they say, that will never come into play because we're going to get sold for $300 billion trillion down the road. And then all of a sudden comes the deal where you took $20 million of venture funding, and then the venture capitalist has a 2x liquidation preference, and then you sell your company for $24 million, right? Founders and everyone get zero. Even other investors get zero, right? So that's one important one to look at, because there's a lot of these acqui-hires going around where you're getting acquired for $4 million to come work at Amazon or Google or something, and those liquidation preferences will start kicking in.
I have some good news. Also, we are being on the acquirer side. So acquirers want to retain the key engineering team. They will carve out the portion of the pie to retain the key employees. So what I'm saying is it's all relative. Yes, you do need to pay attention to liquidation preference and participation rights. Those are the things usually first-time entrepreneurs do not pay attention to. Those can be a big game changer when you are, especially in the M&A stage. Valuation, to be honest, there's not so much room for you to play because it's really a function of how much money you need to raise. That's it. and that is decided by you. Okay? How much money you need to raise? Then the VC say, okay, I need 20% of your company. That's it. And that decides the valuation. Okay? So there's not too much room for you to play. So that's why, and these days, investors also get educated as well. So there's no poison pills usually. And even from us, say we emphasize to our mothership, no poison pill. Means what? There's no first right of refusal, blah blah blah, right? So actually you get a very clean term sheet. So I mean, just repeat. The things you should pay attention is the liquidation preference, and not too bad, because even if you get acquired, you get carved out if you're key engineers.
On that, about the valuation is obviously about the ultimate ownership that you will have of the company, which again relates to do I raise a Series A or do I go another route, which is up to you. But if you end up raising a Series A and eventually you will have to raise a Series B, I mean, I don't know how many companies went from Series A to IPO at this stage, and counting on an acquisition is not counting on anything at this stage. Your ownership is going to go down. You probably have all seen the stats about companies going IPO. Most of founders have 2%, 4%, not max. At the end of the day, some do better than others. The thing that I keep on seeing is that later stage investors are generally essentially giving stock options back to the founders. So there are many ways to re-incentivize the founders eventually. Sometimes it's done through some minor recap. Sometimes it's just putting back the ESOP up to 20%. I've seen as high as 30% sometimes, it's a kind of a trick because unfortunately the equity of the founders that is minimal has been fully vested, and we're generally 4 years in or whatnot. They will get new stock options issued, which vest again. But if you are in for the long run, you don't really care anyway. You are just there and you're not moving, and you are ready for the next 4 years. What I'm saying is that there are mechanisms to make it up to you, and I don't think it's in most, if not any, VC in the future to just screw the founders because you are running the company in the first place.
Okay, I think that is going to be all the time we have for questions from me. Now it's all of your turn to ask some questions. Ryan's going to be carrying the microphone around. When you ask the questions, stand up, state your name, your company. That's about it, not your 60-second elevator pitch. And then be specific on who you're asking the question as well. And we'll hopefully get as many questions in as possible. But please do be brief on your questions, okay? You are not the speaker, you're the question asker.
All right, first up.
Hi, Marisa McGinnis. I'm an investor. Can you talk a little bit about bridge financing? I don't really understand that well. Is it a loan? Is it a...
Typically speaking, bridge financing, the term comes from bridging you between one round and another. I have a little right, convertible. I have some gray hair, and in my day, that was called a down round. Today, the bridge financing becomes a seed extension, or you're bridging between that seed and Series A. So it's typically done with equity, right? So it's typically done, convertible note into equity. Very rarely these days is it done with debt. Bridge financing has been kind of phased out, and the concept of venture debt has been phased in. And venture debt usually will allow you to finance operations. Like in Cyril's world, it would finance manufacturing when you have a lot of orders, and you could take some venture debt, which is basically non-equity based sort of venture financing. But you pay it back at a pretty steep rate, and it's used for very specific things. It was kind of invented in the gaming industry, again with CAC. Like Zynga knew if it cost $6 to go get a customer, then they're going to go spend $36. So the venture debt industry was built around that, and then eventually came out.
The bridge is always coming from insiders. That's an important distinction between a pure raise, which will come from insider investors. So it's essentially everybody in being like, oh, this company is doing well, they're falling short, and we think the next milestone is X, and we're going to invest Z into it. It's depending on the situation, it's a signaling problem. because if it's a down round, then it sucks for everybody generally. If it's so generally a bridge would be generally made at the last valuations, it would be a flat round. But sometimes strategically, it will be done through a convertible note with a cap, which would be higher than the valuation. And it's trying to peg the valuation of the company to a higher level for the next investors to come in. And then there will be a discount. So if it's $20 million, there will be a discount so that essentially they've already invested in the next round in a way.
Hi, my name is Jasmine Shi, and I'm with Golden Seeds. We're focusing, but the point I'm trying to ask is that what's the percentage of the companies you guys see, and how many percent do you invest, on an annual basis?
We see about more than 1,000 companies per year. We make about 20 investments per year.
Try to be specific about like just as far as applications or decks sent to you, or in how many meetings. Kind of break that down. The investor funnel. I had a whole another set of questions for that we didn't get to, but break down the investor funnel for us.
Out of the 1,000, probably we hold meetings for about, I would say 20%. And then we have an initial diligence, then deeper diligence, then lead to investment, right? So I would say it's a few percent basically success rate, right?
And, the number of the ratios are the same, but I'd say we probably touch 500 companies. Some of them come from like my friend from high school, I haven't spoken to in 20 years, sends me an email with a cold introduction to his friend's company. Very rarely will we meet those, to the ones where people we've invested with will then say, hey, would you like an introduction to this company? And probably about 20% of that 500 we meet, and we probably make about 12 to 15 investments. But of those 15, probably five or six are follow-on to a company that's already in our portfolio. So for new investments, it's probably 10 or less in that perspective.
All right, we're a bit specific because we're vertical, and in life sciences, we'll see probably a few hundred companies and investing 30 per year. In the hardware space, we will see probably about 2,000 companies. We will talk to, 400, and we'll pick up eventually 50 of them per year. Out of those 50, between 70 to 90% of them will raise $1 million, and then I don't know about 5, 10, then continues to go down. But essentially, since we started 5 years ago, we have the Series B getting started. Probably you will count on raising your first $1 million in the first year or so. It's debatable whether 2 or 5 is what's in the next 2 years. And the Series A will come in year 3 to 4, and the Series B in year 5. So still a long way. But I think the official odds are still fairly light, because the official VC, which is again a Series A VC type of firm, will do 1 out of 10 will make up for the entire fund, and 2 or 3 will make all right or return some money, and the rest is gonna die. I was talking about Series A here, so at Series C or Pre-C, where even greater or worse odds than that.
Next question.
My name is Fiona. I'm student in CV and company. My questions around like those Series A companies, pre-Series A companies. What are the are there any liquidation promises or participation rights, or any similar terms for serving that kind of purposes?
Or a pre-Series A company? Typically nowadays is all done through convertible notes, which typically do not have right of first refusal, tag along, drag along, and liquidation preferences and things like that. So that typically the first time you'll encounter that in an SPA, a share purchase agreement, would be at your Series A. So typically a pre-Series A company would not have it. And you asked about flags before. Nowadays, if you're seeing a very complicated seed investment pitch. It has all that kind of stuff in it. It just seems to me that it's either premature and that it's over-engineered and you have some crazy lawyers or a crazy founder, or they've been around way too long. Right? So typically it's done without the lawyers and using the safe docs.
This is a very long conversation, but convertible notes can be really evil. I would encourage all of you to do a price round before you get into a Series A so that you know what doing a price round is and so that you have a clean cap table to show future VCs. You like clean cap tables, or you like messy convertibles with different caps, or what do you like?
Talk about how the lawyers can't do that.
Yeah, one thing you need to be very clear. Convertible note holder are the debt holder. They need to get paid first. So that's basically just out of the book, that's 1x liquidation preference.
To add on to that, I mean, you can easily study the standard notes, like if they're using a safe note or a KISS note, like a 500 Sharps KISS note or YC safe, you can generally find those online quite easily. Some notes, like especially on the KISS side, if you're using 500 Sharps KISS, they do typically have participation rights and some basic liquidation preferences as far as in the case of acquisition. And also something else you'll occasionally see, depending on what stage you are, you might see most favored nation clauses as well as another term that you should probably be aware of. It just means that if I'm going to give you $5 at a $10 valuation, whatever, you're not going to go give someone else an $8 valuation in a month. Okay, it just says that if you give someone a better deal than me, you got to give that to me too until you raise that next round. But those are some key terms that you might see or might not. Ryan, I think.
This is for Cyril. My name is Brady Simpson from simtech.io. So hardware is very different from software, and it's obviously really difficult and different to scale hardware. What are, in seed stage investments, what is the type of traction you're looking for when making a decision whether to invest?
Yeah, so it depends also what type of hardware you do. If it's consumer health or B2B, you are going to be in very different places. And consumer doesn't have really much favors these days, but they have also Weapon, which is pre-order, Kickstarter or general pre-orders as well to kind of self-finance or at least get to a meaningful traction that they can show potential seed investors that could be interested in their space. In the B2B space, it's going to be more or less of the same in terms of how many pilots and what's your funnel, and it's going to look like more of a traditional SaaS company out there to get there. But and in health, generally people will ask for some kind of data. But what I'll say that is fairly consistent across everybody is that they do have it's a prototype. It's something that will eventually be manufactured. That is manufacturable, meaning scalable in this case. So the bar is already fairly high, and that's should be so replicable and sufficient to convince a seed investor to be believing with their own eyes whether or not something can work. But in some cases, they are going to send back the companies to pay into 6 months of data or something, particularly in the B2B space. But if you have something that is scalable, if you have the expertise in the market, if you have some installations, if you are selling something, you should be able to raise 500K, you should be able to raise $1 million without suffering too much. It's to raise above $1 million where if it's B2B hardware, then data is gonna ask for 6 to 9 months. If it's health, I'm going to ask for 6 to 9 months of health data as well. If it's consumer, then it's gonna be asking for did you ship, and are you when are you getting into retail type of sales, or what is the next product type of thing. So yeah, hope it helps a bit.
My name is Dimitri from Bitaway. I'd like to hear from all of you guys, what does the typical roadmap look like from the moment that a founder gets in touch to the point that you decide to invest? I understand there's some kind of relationship building, some kind of courtship. So what does that look like? How long does it last? Probably different for every case, but just a few examples. Thanks.
It depends, right? I have seen our portfolio, we made a decision within 1 week. Or I have seen that in our portfolio, we made a decision within 3 months, right? But all I'm saying is that there are good case and bad case. Those are very easy. Bad case, we say no right away. Good case, we say yes right away. The things that takes longer time are the ones that are fit in between. And for us, we are at that time we are doing due diligence, but we are also doing free business development for you inside Samsung. So basically, you are not wasting any effort here.
So we have myself and 2 other partners, so there's 3 partners. And typically the process goes, you meet, if you've gotten through the email stage, the deck stage, all that stuff, and you've got that kind of proverbial coffee meeting, you meet one of the partners. If that partner finds it quite interesting, then they'll say, well, you have to meet another partner. And then you meet another partner either in person or on Skype, preferably in person. And very quickly after that, we'd make a decision, once the due diligence portion is done. So the only thing that would kind of delay that would be if, we've got, let's say, 10 due diligence questions. If it takes forever to get that data, or part of due diligence is we want to talk to an existing investor, talk to an existing customer. If it takes you 3 weeks to make an introduction to an existing investor, it takes you, it's going to process it take 3 weeks. So like you said, we've made decisions in a week, and we've made decisions in 3 to 6 months, and it's just it's kind of a 2-way street in that respect. We'll work as fast as the entrepreneur will work.
It's really difficult because every single investor will behave very differently, and in some cases, they will have theories about where markets are going, and then they will stumble upon the company, and that will be it. They will make the investments because all the stars line up. Some of the times they will be after the company as well, and notice that there was something going on. It can literally be at an event, it can be a PR stuff, it can be at a demo day. All those sounds kind of old school, but there is still some mechanism that works here. And when I was doing real direct investments into companies, I remember reaching out to them because I saw them on press and being like, hey, I want to be part of this because that's something that I believe in and I believed in before. And it sounds like you're the right company. For the rest, as mentioned earlier, there's the no's. Or actually more of the ignoring, or sometimes relationship building that can happen. Literally, for us, sometimes it takes about a year. It's just like we're trying to direct the founders to certain milestones that they have to do, and in hardware it's longer. So it's like you should take those steps, and maybe it will take six months to get to those steps and get on together. Some of the times, literally a day. Being like, wow, this is fantastic, great team, we can do it. From a VC perspective, I think from a Series A perspective, this is much more difficult. But I've seen also decisions being made very, very quickly if there is pressure. At that point at Series A, you are talking about a different fear of missing out, which is linked generally to your traction, and you can shop around. But everybody wants to be in that position, obviously.
I want to build on what he just said, is that last piece is incredibly important for solidifying ground. You will talk to 50 investors and probably half of them will say they're slightly interested or send me some more information or something like that. And a lot of times they'll go quiet immediately. I see this happen all the time. But really what's gonna be the difference between someone willing to do a deal with you in 3 days versus doing a deal in a year, it's gonna be you. At least one major way to do this is you somehow communicating and showing that there are many other investors jumping on board, and investors that they respect. If you can somehow kind of get this somewhat critical mass of VCs and show and kind of create some competition, the deal can be done really, really quickly. VCs all have major FOMO, so use that to your advantage.
I'll finish on that, but the best fundraise I've seen from some companies was literally done via email on the monthly news of how the company is doing and metrics attached to it, traction, at some point, 3, 4, 6 months later, oh, by the way, we're fundraising XYZ, and by reading, for 6 months the testimonials, some investors just won't read it, but you can count on 30% to read that email. They'll be like, oh, okay, that's something's happening. Oh, and by the way, we have 30% of the rounds committee, 50% of the rounds committee. It's kind of a drag, but it's very important. And either way, you have to make that email every month to your own investors or to the next investors. So just build your own little database of people you meet and think of it long term. But absolutely, every single email coming out every month should be preparing the next round.
Hi, my name is Abid Hussain. I'm an advisor and angel investor. I thought I heard one of the panelists, I can't remember which one, said it's, maybe I misunderstood the answer or the question, but I thought I heard that there was a recommendation to do a priced round in between a convertible and a Series A. That's the first I've ever heard of that. Is that realistic? Is that an ideal scenario? What's the rationale behind that, and how would you go about doing that? Who would be the source of investors? Seems like a little bit of a limbo. Forgive me, maybe I misunderstood the question.
Yeah. All I'm saying is in general you should not use convertible notes because they are just going to keep on piling up, and then they're going to put a mess in the next valuation round because the notes are converting at pre-money valuation. And effectively inflates the next round's raise, and it lowers the next investors, being the VC who is actually putting the money. It lowers their potential equity position in the company, and so it just adds layers and layers of talks, and sometimes they have different caps and whatnot, and the conversion can become pretty brutal because the VC will get exasperated with it, and they'll just call the terms and being like, well, this is going to be the cap table at the end of the day. Goodbye. Take it or leave it. So if you can, and I know on the other side, making every single deal price run is a pain. But we're going through that at the moment with a company doing some kind of down round, and we've literally been having like 4 different nodes at different caps over a year. And there is the clause that Bharat mentioned of the most favored nation, which eventually will kick in. But when you think about the Series A and you see those caps everywhere, you have no idea where it's going to land, and you wish you would know by just doing an actual price round at the valuation that everybody's kind of cool with it, and enough capital in this case for the company to go on. So there are minor recaps happening. That are absolutely possible, but there will be more of a after the bridge. It's the bridge. You have the first bridge and it doesn't go right to get to the Series A. That's the next one where the decision needs to be made about, okay, we price it and there's $2 million in the bank, and then we can get to Series A.
Last question.
Hi, my name is Nicole.
Hello?
Yes. My name is Nicole. I'm a student, and I do fundraising at school, and I'm just interested in it. And I want to ask, maybe Raymond, for the bike sharing fashion in China, like the Ofo and Mobike, they want to expand the markets in US. Do you think that will be a success, and will your company be interested in investing in them?
Well, the many ifs. Right, but I think they're solving an important problem, which is the last mile in transportation, in mobility in general. I call this mobility as a service, right? But Mobike and Ofo, they are successful because the unique situation in metropolitan China. Because basically, I don't know if people are aware of this in general. You basically you can it's like a Uber for bikes, but once you take it, you can just leave it at your destination. You don't have to ride it back to a station. Okay, so that really solves the last mile problem. But this only works when you have a huge population. If I ride my bike to a remote village, I just leave it there, then that's dead end, right? So that's why I would say this model works probably in New York City, for example, inside San Francisco, but that's a little bit challenging because you have a hills, right? So that's why I'm saying that in many areas this model works, but not universally, right? And there's a lot to do with also, you know, Uber is not just simply like, hey, I have the app. They have a huge amount of logistics behind the scene, right? The optimizations, all those things, right? What kind of a promotion they target you or the driver, right? So all those things actually, at the end, we decide which of these, you know, bike sharing company will be more successful. But a few of them already, they are unicorns, right? We know that.
All right, well that will conclude our panel. Thanks for the questions, everyone. Appreciate that. And thank you so much for our panelists. That was very educational. Everyone's going to learn a lot.